Hey guys, welcome to the Our Rich Journey podcast. That's right, I said podcast. You see, we are doing something brand new at Our Rich Journey. We are also starting a podcast. But for this particular podcast episode, we are putting it here on our YouTube channel, our general YouTube channel. But we have also created another YouTube channel that focuses specifically on our podcast because this podcast is going to be focused strictly on answering your questions when it comes to investing. And so normally each week we are going to be answering listener questions that you submit on our website, ourrichjourney.com/podcast. We will be answering those questions here in full detail, giving you our feedback and what we would do if we were in your situation and you need to make some sort of investment decision. Now, normally that's what we're going to be talking about on the podcast. But this week, we're going to do something a little special because it's our new podcast and there have been some crazy things happening in the stock market. You see, this week, the stock market has been literally crashing. On Tuesday, the stock market, the Dow Jones, fell over 1,000 points. And so for this first podcast, I want to take this opportunity to talk about the current state of the stock market and things that you should be doing moving forward. So to get this conversation started, I think we need to take a look at how the stock market has performed this week. Let's look at the Dow Jones Industrial Average. So this week, the Dow is down 4.1%. It fell over 1,000 points on Tuesday when the CPI came out. You see, CPI, it's the Consumer Price Index, and it showed that inflation was not going down. In fact, it had gone up month over month, which for a lot of investors is seriously bad news because it means that the Federal Reserve is going to continue to raise interest rates to combat inflation. And so the expectation is that the Federal Reserve is not only going to increase interest rates this month, but also the month after, another 0.75%. And so for investors, this is bad news for a lot of reasons, but one of the big reasons is that when the Federal Reserve increases interest rates, it slows down economic activity. And when economic activity is slowed down, profits of companies also begins to slow down, and investors do not like that. The second big thing that happened this week is that FedEx had their quarterly report, and they reported very negative numbers. And moving forward, they also set the expectation that they were expecting business to slow. Now, FedEx is a delivery service that services virtually most businesses in the US economy, most businesses around the world. And so for FedEx to say that they believe that their business is going to slow down, one could translate that as businesses worldwide are going to be slowing down because they're going to be shipping less through FedEx. So when the stock market saw FedEx's report, they saw it as the canary in the coal mine for a major recession that could be underway. Now, this was also a week where we saw a lot of really good companies go down with the stock market. It was almost like investors were throwing the baby out with the bathwater because sentiment was just so negative. Companies like Google, Amazon, Nvidia, Microsoft, Adobe, all of these companies, their prices were just going down at just astronomical rates. We saw our favorite ETFs like VTI, VGT, QQQ, these investments go down significantly. And so if you are a long-term investor, if you are seeing these types of price declines, this I think is a major opportunity for those that have been waiting to get in, for those that have been waiting to add more to their position, or those that have just been having money on the sideline and they want to put that money to use. Because I can tell you, if you were investing in 2008 and you missed that opportunity to buy more, you're probably kicking yourself in the butt because you didn't think that opportunity would come up again. Well, we may be in one of those situations. We may be in one of those 2008 situations where we're seeing the stock market go down 20, 30, 40%, only to have it rebound astronomically in the following years. And so, is this that opportunity where you're able to buy great companies at a discount? We think personally that it is. Now, that's based off of the analysis that we've done, but I'll just give you one example of a company that is an amazing company that is currently being brought down because of the overall sentiment in the market, and it's Google. You look at a company like Google. Google is tremendously profitable. Google has what we like to call a moat around their business. It's virtually impossible to compete with a company like Google. Yet, you look at Google's current share price, it is trading near its 52-week low. You can practically buy Google for less than $100. I think the last time I checked, it was around $101, $102. If Google falls below $100 and Google is on your watch list, I hope that you are taking full advantage of this opportunity. Now, I'm not saying that you should go out and buy Google right now, but I'm saying if you have done the research and you feel confident in investing in a company like Google, this may be the opportunity that you've been waiting for. Now, so there's Google, but there are other companies that we have been keeping an eye on, that we have on our watch list. And so if I'm looking at my watch list, it's of course Google, Amazon, Nvidia, Johnson & Johnson, Home Depot, Disney, and then when we're talking about ETFs, it's VGT, BTI, QQQ. Some of these companies and some of these ETFs are down 30, 40, 50%. They are trading at their 52-week lows. Historically, what we are experiencing right now with high inflation, with interest rates rising, these are all things that we've seen during previous markets. You know, look at the bear markets that we had in the 90s because of high inflation and high interest rates. Look at what happened in 2008. If you stayed the course, if you added to your portfolio during those periods, I mean, the returns were tremendous. And so is that what's happening right now? History repeats itself with the stock market. The stock market is a cyclical beast. And one thing that happens in a market is at a certain point, the values just begin to go too low. And you start to get those investors that come in, they're value investors, and they start to pick up all of these deals. This is what Warren Buffett is famous for. This is how you build wealth. You build wealth in a bear market. You are buying low so that you can sell high. So keep that in mind. Now, over the next couple of months, if you're investing right now, there's a good chance that the investments that you are buying now, they could go lower, because these next couple of months are going to be very tumultuous months. Next month is earnings. That's when the earnings season kicks off. And so a lot of these companies, a lot of these Amazon, Googles, a lot of these big companies are going to be reporting earnings. Every major company that reports, there is going to be a shift in the market. And so you could be investing at a time where there is going to be some significant volatility in either direction. I'm not saying it's going to go down. It could also go up. It is hard to anticipate what's going to take place at this time. But with this type of sentiment, anything that looks strange in an earnings report is going to be scrutinized one way or another. Now, for those investors that are in the accumulation phase, it's so great that you are in this phase because you are able to dollar cost average into these investments, either through your employer. Every time you get your paycheck, you siphon a bit of that off into your brokerage account. You should be constantly building wealth by dollar cost averaging into the market. Now, for those folks that are retired, like we are, this is a time when, for us, we are not pulling from our investments. We are letting our investments compound. We are letting dividends be reinvested. We are taking the profits from our real estate and we are pouring those into the stock market. We are not withdrawing from our stock portfolio at a time like this. You see, one thing that we talked about when we talked about retiring early is that we have something called a stock market emergency fund. And the idea with that for us as early retirees is that we keep a large amount of cash, at least 2 years worth of living expenses in cash that is accessible should the stock market go down into a bear market and we do not want to pull from our stock investments. Instead, we can live off of this emergency fund until the stock market recovers. Because for retirees that are living off of their investment portfolio, you do not want to be pulling from your investment portfolio when it is at this level, when it is down like this. We talk a lot about that in some of our other YouTube videos. Go check out those videos. We're talking about our emergency funds, how to invest for financial independence, and things like that. So just keep that in mind if you are a retiree or if you are on this journey and you wonder what you should be doing when the stock market crashes like this, when it goes into bear territory, especially for a prolonged period, how you should be living off of your portfolio. The next thing is that how long this bear market lasts, it's really hard to say. But since 1947, there have been 14 bear markets. On average, it's taken the bear market 12 months to bottom out and about 24 months to fully recover back to its highs. So we've been in this bear market for about 6 months, maybe a little less. And so we could have on average, we could be spending a little bit more time in this bear market. And then, of course, the recovery could take even more time. But again, it goes back to this is the period where you build wealth. When you are investing, when the stock market is at its lows and you are consistently investing, you are getting a discount that is going to prove to be very, very beneficial when the stock market recovers. So that's our weekly recap for the stock market. Next week, we will be answering your questions. So make sure to go over to ourrichjourney.com/podcast and leave your question so we can read it here on our podcast and give you guys our insight in how you should address your investment question. And so if you guys like this podcast, make sure to leave it a review wherever you are listening to this. And also, if you are watching this on YouTube, make sure to hit that notification button, give us a thumbs up, and subscribe to our channel. And as usual, we will see you guys next week.